Right. So last week we got cracking on foreign exchange. We discussed some of the basic concepts, right? The base currency, counter currency, the settlement date, value date, transaction date, and all that. And then we moved on to an interesting theory, purchasing power parity. Yeah. Then we discussed about regulations, and some of the basic aspects of regulations, why it's good, why what are the drawbacks of regulations, and all that. Any questions from last week? I can take a few questions until I can give about a minute for questions. Anything that you would like to clarify from last week? No questions? Okay, so in that case, we can continue from where we stopped last week. Yeah, shall we try this question? We didn't do this last week, isn't it? Can we try this? Question number 1. Given the exchange rate of 132, dollar rupee rate of 132, if you have $10 million, how much can you get in rupees? And if you have 100 million rupees, how much can you get in dollars? Right? So the exchange rate, let's write that down first. $132. Okay. So based on what we discussed last week, this is the base currency. Dollar is the base currency. Rupee is the counter currency. Okay. And this is a direct code. It says $1 in terms of rupees is 132. Right? The exchange rate is more than 1. So the base currency is strong. Yeah. So that's a bit of a recap from last week. Right? You have $10 million. This says $1 is 132 rupees. How much is $10 million? So very obviously it is 132 into 10 million rupees. 1,320 million rupees. Can you all see the board? Is it shining? Yeah. So any questions on this before we move on? Make sure you clarify your doubts, because things are going to get a little more complicated. We are going a bit deeper. So just make sure you get the basics right. No questions? Let's move on. You have 100 million rupees. How much can you get in dollars? Right. You have 100 million rupees. How much can you get in dollars? Now, what have you got to do? So simple grade 5 maybe grade 2 calculation. Isn't it? According to this exchange rate, 132 rupees will buy you $1. Right. So 1 rupee will buy you 1 over $132. With 100 million rupees will be 100 million divided by 132 dollars. So you will notice that $10 million will give you more than 10 million rupees because the base currency is strong. Then 100 million rupees will come to less than $100 million again because the base currency is strong. Yeah. Any questions on this? Any questions on the calculations? No questions. Let's move on to the second one. Euro sterling. Yeah. Then in this case, euro is the base currency. And if I may ask you, which currency is strong? What do you think? Which currency is strong? The euro is strong or the sterling is strong?
Sterling.
Yeah. Reason?
Less than 1.
Exchange rate is less than 1, so the base currency is weak. But in other words, 1 euro is 0.8585 sterling. If you have 10 million euros, how much can you get in sterling? So 1 euro will buy you 85 sterling. Therefore, 10 million euros will buy you 0.8585 into 10 million sterling. It is 8.585 million sterling. Clear? Next question, if you have 10 million sterling, how much can you get in euros? So it's the other way around. 85 sterling will buy you 1 euro. Yeah. So 1 sterling will be 1 over 85. Okay. So, if you have 10 million sterling will be 10 million into 1 over 85 euros. It's about 11.65 million euros. Okay, sorry about that. Right, we are back. Any questions? No questions, okay. So let's assume the price of one mango is $100, right? Then if the price the next day is 110, one mango is 110. So the first day the price is 100, next day it goes to 110. What do you think would have happened? The price of a mango has gone up or gone down?
Gone up.
Gone up, exactly. Yeah. So the next slide on your tute. Is $1 US is 132.20, and then you find it at 132. This means the price of the dollar has gone up or down.
Gone down.
Gone down. Yeah. And the percentage drop. It has dropped by 20 cents, isn't it? A 20-cent drop. The percentage drop will be 20 cents divided by 132.20. What a 0.15% drop. So the next question, sterling dollar 152.50, and then it is at 152. What do you think has dropped? Now in this question, which one has dropped? The dollar has dropped or the rupee has dropped?
Dollar has dropped.
Dollar has dropped. In the previous example, original example, what has happened? The mango has increased in value or the mango has dropped in value? Mango has increased in value. So if the price goes up, that means the base currency is increasing, strengthening. But if the price goes down, the base currency is weakening. Right? So with that in mind, try this example, the next one, sterling dollar. Right. So my question is, which currency has strengthened and which one has weakened?
GBP is strengthened than US dollar.
Okay, yeah, I get your point. What you mean is GBP is stronger than the dollar, but the next instant, if you see the exchange rate at 152, which currency has strengthened and which one has weakened?
Yeah, then US dollar is strengthened anyway.
The dollar has strengthened against the
Dollar
sterling, right?
against GBP.
Reason is because the exchange, the price has
It comes down,
dropped.
drops.
Yeah,
Yes.
price has dropped. If the price drops, then the base currency weakens. Right? In this case, the base currency is the sterling, so the sterling has weakened. The sterling is weakening, that means automatically the dollar is strengthening. Weakened by how much? $50 basis points. Percentage. Percentage. .33% drop. Any questions? Okay. Now let's say you have you want to or let's say let's assume that you have a mango plantation, right? And you want to sell this to a supermarket. You go to a food city. Right? and you sell mangoes to them. Okay. Let's say they buy mangoes from you at 90. They're buying mangoes at 90. Now for the supermarket to make money, they should sell the mango at a price above 90 or below 90. They want to make profits.
Above 90.
They have to sell above 90. So they will sell, they're buying at 90 and they will sell it at, let's say, a price of 100. Yeah. So the buying price of the mango is 90, the selling price is 100. Now who is quoting this price? The customer is quoting or the supermarket is quoting? Both prices, who is quoting? The supermarket is quoting, isn't it? So the supermarket is the market maker. They are making the market. They will tell you that they will buy mangoes at a price of 90. They will sell mangoes at a price of 100. Yeah. So the buying price of the mango, which is the base currency, is 90. The selling price of a mango is 100. Base currency, price of the base currency. Buying 90, selling 100. Clear? So this is the price of a mango against a rupee, 90, 100. Base currency is the mango. Base currency of the mango will be bought at a price of 90 and the base currency will be sold at a price of 100. Who's quoting this? The market. So the buying price, the market maker's buying price is called the bid. Selling price is called the offer. Bid and offer. Okay. And the difference between offer and bid, offer minus bid, you give the profit. So if you walk into a supermarket and you want to buy a mango at these prices, you will buy the mango at what price?
100.
100. And if you want to sell a mango, you will sell it at the supermarket?
90.
90. Okay. So those represent the buying and the selling price. Now if you take a rate sheet of a bank, they will have bid and offer. Which is you have buying prices as well as selling prices for currencies. You have DT buying, draft buying, currency notes buying, 3 different buying prices, and then you have the selling price for a currency, for any given currency. Then my question is, Buying and selling prices are there only for currencies, or what about interest rates? Do you have bid and offer for interest rates also? Can you have a bid and offer for interest rates?
Yes.
How would you explain that? Your answer is correct.
Cost of funds?
Huh? Come again?
Is it cost of
It was
funds?
Beg your pardon? Hello?
Cost of funds?
Yeah. Actually, you have deposits and advances. So deposits, you have your current accounts, your savings accounts, FDs, and all that. Maybe call deposits, repos, isn't it? Advances, you have your loans, maybe housing loans, ODs, PODs, and all that. Perhaps pawning, credit cards, which is lower. Deposit rates are lower, lending rates are lower.
deposit rates.
Yeah, deposit rates are lower. So you take deposits, maybe your savings account rate is 3%, and your housing loan rate is 7%. Right? So you take deposits at 7%, 3%, and you lend it out at 7%. So that's bid and offer. Clear? Right. So bid is the rate at which the market maker is willing to buy the base currency or sell the quoted currency. Offer is the rate at which the market maker is willing to sell the base currency or buy the quoted currency. Yeah. So the basic rule is you need to buy low and sell high, right? Buy it low, sell it high. Remember that. Buy low, sell high. When it comes to bonds, it is the opposite. Buy high, sell low. But don't get confused. Usually it is buy low, sell high. Yeah. So if you have any questions, you can always ask. Then the spread, right? Offer minus bid. Is called the spread. Gives you the profit. Spread is the difference between the offer and the bid. It gives the income for the price maker or the market maker. Margin or the profit margin is based on the bid, market bid and offer. That's the difference between the bid and offer gives you the margin. And the next point is how an exchange rate is quoted. Right. For this example, euro dollar quoted as 132.75. Right. Now, in exchange rate, the last two decimals, are called pips. Pips. Okay. What comes in front is called the big figure. then if you take the dollar against the rupee, say it is 200 rupees and 10 cents. The last two decimals are called pips. Whatever is in front is called big figure. So why it is important is because what is quoted in the market are only the pips. Only the pips get quoted in the market, nothing else. Only pips. For example, the market might say euro dollar is 75.80. They will say the euro dollar is 75.80. Only that is quoted. Yeah. Now this quote is they're quoting only the pips. Big figure is not quoted. So how do you know the big figure? The underlying principle is if you are a participant in the market, you should know what the big figure is. Right. Join the market. You should know the big figure. What will be quoted are the pips. Okay. Let's try this. Says the middle rate for dollar rupee is 127.50 if the bank keeps a margin of 25 cents per dollar TT. Rates are fixed as follows. So the middle rate, before that, remember bid and offer, the price of a mango, 90 and 100. Yeah. So the middle rate will be 90 plus 100 divided by 2, which is 95. That's the middle. So in other words, it is the bid plus offer over 2 gives you the middle rate. So in this example, the middle rate is given as 127.50. And the bank keeps a 25 cents margin, meaning, see, sorry, erase the mango example again. Write it once again. 90 plus 100 over 2 is 95. So the margin for the big is 5 rupees. It's 95 minus 9. And the offer margin is 100 minus 95, again 5. 5 rupee margin is maintained. Yeah. So the margin, if it's 25 cents, the bid should be 127.50 minus 25 cents. 127.25. And the offer should be, it has to be more than the middle rate, so 127.50 plus 25 cents, 127.75. Okay. Clear? Any questions? There are no questions. Let us move on. Okay, so no questions. No questions means you either understood everything or you understood nothing. Right? Okay.
Yeah, sir. Locally, when it comes to the Sri Lanka, so who decides the bid rate actually?
Who decides the bid rate?
Yes,
Uh,
locally.
Any reason to ask only the bid? What about the offer? Why not offer?
The offer depends how the demand and supply goes, right?
Same thing applies to bid also. Yeah, you answered your own question.
Is it?
Yeah. It's based on demand and supply.
Okay,
See,
sir.
in the market, there is no such thing as a middle rate. There is no such thing. Right? There is only a bid and there is only an offer. When you average the two, you get the middle rate. Right? So the middle rate is not quoted in the market. It's non-existent. It's just the average of the bid and offer. So what exists is only the bid and offer. Middle rate is something that you need to calculate. Clear? So if there are more offers, that means there are more sellers in the market. When see more sellers means more supply, no? Yeah. So more supply, the price should go up or come down. If supply increases, grade 2 economics. What do you think? When supply goes up, the price should go up or come down?
Come down.
Come down. Yeah. And when there are more bids in the market, more buyers, then the price should.
Go up.
When there is more, yes, more demand, the price should go up, right? So it depends on demand and supply. Okay, good question though. Any other questions? Yeah, these are the kind of questions you need to ask. Intellectually stimulating questions. Very good. What else? Well, actually, what you learn in class, you can read a book and understand. Very simple. It's through asking questions that you get the opportunity to make use of my experience, maybe my knowledge. Right. So feel free to ask questions. And let's try and make this interactive and knowledge sharing. Okay, any further questions? Nothing?
Sir, central bank also intervene in deciding the rate.
Yeah, they do. Most central banks in the world, not every central bank, but many central banks intervene if they feel there is an undue fluctuation in the exchange rate, and sometimes to keep markets stable. Like because central banks don't like shocks in the market. They want to try and avoid shocks as much as possible. So they intervene, right? If they see something going out of hand. So if a central bank is intervening frequently, that means perhaps the market is not very stable, and perhaps they feel volatility is a little too high and markets should settle down, right? Good question. Did I answer your question? Yeah.
Okay.
All right. Next one. Now, if you want to deposit money into a bank account, right? Or if you want to withdraw money from an account, you have to go to a branch. Well, just forget about internet banking. You have to go to a branch and fill in a form, sign it, give it to the teller. He'll put it in the system, authorize, then it has to go to someone else for authorization. Right? One guy enters, make a checker system, One fellow enters, the other guy authorizes. Long process. So even to deposit a 100 rupee note, that is what you need to do. You have to follow the process. But when it comes to foreign exchange transactions, bond transactions, any treasury related transactions, right? The millions of dollars are dealt with within a few seconds. Everything that happens, the transactions happens on a screen like this, a basic like a chat screen. Yeah. So if you go through what is given here, where you get the hash sign, it says AUD 5 million. That means he's asking for a quote for. He has said AUD. It means AUD US dollar, right? Australian dollar against US dollar exchange rate. That's what he's asking. 5 million. He has mentioned as 5 million. So what is this 5 million? Which currency? Aussie or US? It's the base currency. In this case, Aussie US is a indirect quote. Aussie is the base currency. They are asking 5 million Aussie US, right? What is exchange rate? Then he gets a response from the blue color font from Sven, who says it's 1517, right? So these are the pips that are being quoted. Sven has quoted the pips. Yeah. Then the trader says, I buy. $5 million Aussie US dollar. Nalika says, I buy. Now, who is the market maker and who is the market taker? Sven or Nalika?
Nalika is the taker.
Nalika is a taker. Market maker is Sven, because he's quoting the rate. And the person who quotes the rate, remember, when you go to the supermarket quotes the price of goods. They are the market maker. You are using those prices, you are the market taker. Right? So if you ask for a price, you are the market taker. If you are quoting the price, you are the market maker. Sven has said 1517, which are the pips. Yeah. So Nalika says, I buy. It's like Nalika has gone to the supermarket and he's buying mangoes. And so if he is buying, he will buy at the bid or the offer. You go to the supermarket, you will buy at the bid or the offer. You buy mangoes at the bid or the offer. At the offer. Yeah. Right. Exchange rate 1517. Offer is 17. You have bought means you have bought at 17. What have you bought? Mangoes. What are the mangoes in this case? Australian dollars. Those are the mangoes. It's like mango rupee. Right? How many mangoes? 5 million mangoes. Australian dollars 5 million. He has bought. Yeah. So Nalika has bought Australian dollars, which means to buy Australian dollars, he is selling US dollars. Right? He's selling US dollars, buying Australian dollars. So Nalika should get Aussie dollars and Sven should get US dollars. Now Sven, the blue text is saying JP Morgan Chase New York, because Sven is getting US dollars. He wants Nalika to transfer his dollars to JP Morgan New York. And he has given the value date at 31st January. Right. The Nalika says to confirm. Now he gives the big figure also, 0.99. 0.99. That is the big thing. These are the pips. Now he says at 0.9917, I buy 5 million Aussie dollars on the same value date, 21st January, and he wants to transfer the Aussie dollars to Reserve Bank of Australia. Simple as that. This takes less than 10 seconds. Okay. Any questions on that? No questions? Okay, let's try these questions. Let's try this. So it says the dollar rupee 132.50 and 134.74. First question is very easy. What is the base currency? Base currency is obviously the first currency, which is the dollar. Right? The bid 132.50, offer is 134.74. Very simple. Next question. Dollar yen. And then 290.95. This can be written as 102.995. So what has been given are the pips 102.90. 95 means it's 102.95. But in the previous example, it says 132.50, 134.74. Now, if that is the case, you can't give 50.74. Why? Because the big figure is not the same. It is not the same. two different big figures now, 132 and 134, right? So what do you all think? At what rate can you buy dollars? Beg your pardon?
95.
Very good. 95. Very good. Next question. What rate can you sell yen? What is your answer? What rate can you sell yen?
Same rate.
Okay. Why do you say the same rate?
Where that means when we selling Japanese yens means buying USD.
Very good. Yeah. So it will be the same rate. Then at what rate can you sell dollars? It's like selling mangoes to a supermarket. You sell at the bid of the offer. Yeah, 90. Yeah. You need to sell at the bid. Okay, so how do you tackle these kind of questions? You need to follow a few simple steps. First, you need to identify the base currency. Base currency you need to identify. Then you need to know what are you doing to the base currency. Are you buying the base currency or are you selling the base currency? Okay. So the steps are, first step, identify base currency. Second step, what are you doing with base currency? So always assume you're the market taker. Always assume you are the market taker. Like you are going to a supermarket to buy. The next one is sell the base at the bid. And buy the base at the offer. Sell the base at the bid, buy the base at the offer. These are the only things that you need to follow. If you follow these steps, you will never go wrong. So let's try these questions again. Identify the base currency. Base currency is the dollar. First question, at what rate can you buy dollars? You buy dollars is the base currency. You have to buy the base at the offer, 102.95. Then what rate can you sell yen? Sell yen, right? Identify the base, it's dollar. What are you doing to the base? Yen you are selling means dollar you are buying. You buy the base at the offer, 102.95. Third one, what rate can you sell dollars? Dollar is the base. You need to sell the dollars. Right? You sell the base at the bid, 102.90. Okay, any questions on that? No questions, let's move on then. Let's try the next question. Next one is sterling dollar, 153.25, 153.30. First step is to identify the base currency. Base currency is sterling. At what rate can you buy dollars? Right? Base currency is, remember, always think in terms of the base currency. Then you will not go wrong. Base currency is sterling. Buying dollars means sterling you have to sell. Right? So you will sell the base currency at the bid. Meaning you can buy sterling at what rate? At which rate will you buy sterling? Buy dollars means sell sterling. At which rate will you sell sterling?
$153.25.
Very good. You will sell the base at the bid, which is 153.25. At what rate can you buy sterling? You buy sterling. Sterling is the base. You are buying the base. You will buy the base at the offer. Right? So it's 153.30. Clear? Then at what rate can you sell dollars? Sell dollars means you're buying the sterling, isn't it? Base is sterling. So you're selling dollars means base you need to buy. You will buy the base at the offer. 153.30. Okay, any questions? No questions? Let's move on to the next one, which is on euro dollar. First step is to identify the base. Right? Base is the euro. At what rate can you buy dollars? Base is euro. If you are buying dollars, you are selling euro. So you are selling the base. You will sell the base at the bill, 130.10. At what rate can you buy euro? Euro is the base, so you will buy the base at the offer, 130.15. At what rate can you sell dollars? Sell dollars means base you will buy. And you buy the base at the offer, 130.15. Any questions? Any questions on this? If you all don't understand, you better clarify now itself. Is it all clear? Next set of questions. Based on the $yen and the euro-dollar. And 50, 55. So it means 101.50 and 101.55. Euro-dollar. 131.75. First question, what rate Q is the quote, A is the asker. Right? Quota is the market maker. A, asker, or the market taker. So at what rate will the quota sell dollars on dollar yen? Quota or the market maker will sell dollars on dollar yen. So it's like the supermarket selling mangoes. They will sell mangoes at the higher price. So the quota will sell the base currency, or he will sell mangoes at the higher price, which is 101.55. Any questions on that? Question number 2. At what rate the quota buys yen on dollar yen? And so the quota or the market maker buys yen, means he sells dollars on the dollar yen. Market maker will sell the base currency at the offer. So answer is 101.55. Question number 3. At what rate will the asker buy dollars on dollar yen? What rate will the asker buy dollars on dollar yen? So you go to a supermarket and you want to buy mangoes. You buy at the higher rate. So the market taker, asker is market taker. So you buy dollars at the higher rate, 101.55. Right. Now don't get carried away. Don't just close your eyes and put 101.55 for everything. It's wrong. Don't do this. It is wrong because all the answers 101.55 doesn't mean everything will be 101.55. Need to be mindful. Question number 4. At what rate will the asker sell dollars on euro dollar? You know, the market asker is the market taker, sells dollars on euro dollar. Sells dollars means euro is buying. Asker will buy euro at 131.80. Market taker will buy the base currency at the offer, 131.80. Question number 5. At what rate will the asker sell euro on euro dollar? Asker will sell euro. Euro is the bid, the base. He will sell the base at the bid, 131.75. Question number 6. What rate the quota buys dollars on euro dollar? So euro dollar, what rate the quoter buys dollars on euro dollar? Buy dollars means he needs to sell euros. At what rate does the quoter or the market maker buy dollars on euro dollar? Buying dollars, that means he's selling euro. The base currency is selling at the offer. Yeah. Number 7. At what rate will the quoter sell yen on dollar yen? Quoter selling yen means the base currency is dollar. Selling yen means he has to buy. He will be buying dollars, right? The quoter will be buying dollars at the bid. Right? It's like a supermarket buying mangoes at the bid. So the quoter will be buying dollars on dollar yen at the bid of 101.50. Okay, number 8. At what rate would the asker sell dollars on dollar rupee? Now this is just to confuse you. There is no rupee. There is only dollars. So it's not possible to give a dollar rupee rate. But let's assume this is yen, dollar yen. So at what rate does, let me rephrase it. At what rate does the asker sells dollars on dollar yen? The asker will sell dollars on dollar yen. So he's selling dollars means he's selling the base currency. You sell the base at the bid. 101.50. Any questions on this? No questions? Okay, so let's move on. By the way, I skipped one slide, you may have noticed. This one, right? So this explains what I just mentioned. Okay, now in your exchange rate sheets, you may have seen 3 different buying rates, isn't it? You have currency notes, demand drafts, and TTs, telegraphic transfers. Generally, which one is lowest?
TT rate?
TT rate actually is the highest, right? Why? Because let's say currency notes, let's assume your bank has bought dollar currency notes. Now these currency notes, the bank can't use locally. Right? If an importer comes and asks for dollars, you can't give him currency notes. Right? Because then what the bank would do is, they will repatriate their dollar collections overseas. Maybe might send it to Singapore or Dubai, but the dollars that they collect through currency notes will not be used in Sri Lanka unless someone comes and asks for some currency notes for travel. And so these dollars will get repatriated. Currency notes will be repatriated. But only thing is, if you collect a $100 note today, you might not send it across today itself, because this involves logistic costs, right? Air freight, insurance, all that has to be incurred. So you will normally collect it for a period of time and then only repatriate. It takes roughly about 2 weeks, 1 to 2 weeks to repatriate your dollar collections, right? So that means you are giving customers money today. Yeah. If a customer comes to you with dollar currency notes, you are giving him the rupees today itself. If a customer comes and gives dollars to the bank, some currency notes, the bank will repatriate, maybe to Singapore, right? So this might take 2 weeks, whereas the bank is giving the rupees to the customer today. So the bank has given the rupees to the customer today, but they are getting their refund, their rebate, only in 2 weeks, right? Because the Singapore bank will wait for the currency notes to arrive and then only give the dollars. So if the bank is giving, let's say, 200 rupees today itself, let's say the exchange rate, dollar against rupee is 200 today, bank is buying currency notes at 200. Right. The bank is giving rupees, 200 rupees to the customer today itself. But the bank is getting money only in 2 weeks. So there is actually an interest cost for the bank, right? Because they are paying money today and they are out of cash for 2 weeks. So there is an interest charge which needs to be added. Let's assume that interest is being charged at a rate of 6%. This will be the interest charge. So it comes to 199.54 approximately. But there is another catch. Now, when the dollars are repatriated to Singapore bank, if you give this dollar note to Singapore, they will in turn give us only about $0.999. The 1 cent they will keep as their margins. Okay. So if you give $1, you will only get about 1 cent less. This comes to, that is also will cost you. You can only give him into 0.99, 197.54. 197. Okay. So these are for currency notes. Then for demand drafts, something similar. Because the draft will have to be sent on collection. Might take about 2 weeks to realize. So this interest cost will have to be deducted. Then what about TTs? TTs have already hit the account. It's there in your account. TTs are there in your account. So there is no interest cost on TTs, which is why TTs will have the highest rate, and then usually the demand draft rate is lower and the currency notes rate is even lower. Okay, so that's why you have 3 different buying rates. Understood? Any questions, clarifications? So this is in case a customer comes to you and asks you why are there 3 different buying rates. You should know. You don't have to call your treasury. You should be able to give the answer straight away. Then only the customer understands that you're knowledgeable. He will start trusting you. Bank is based on trust now. So one way of building trust is to display your knowledge. Okay. Yeah.
Why do that bank, Singapore bank keeps the margin? So we are depositing to the account, no?
We are depositing into?
Our account, right?
We are repatriating. Right, it's not necessarily depositing into an account. Right, the physical note, we have physical notes. Those physical notes will be sent to Singapore. Right, even if you are depositing to account, it's okay. It comes to the same thing. If you are depositing currency notes into our US dollar account, that process is also similar. They will still give only about 99 cents. Good question. Why is the Singapore bank giving only 99 cents without giving us $1? Because we are giving them a dollar note, they are giving us only 99 cents. Very valid question. The reason is, now Singapore bank is getting currency note dollars now. So dollar currency note again cannot be used within Singapore. They will also have to send it overseas. Maybe from Singapore they have to send it to the US. So when the Singapore bank sends it to the US, again, there are additional costs, maybe air freight or insurance. storage, all that comes into play. So you don't get 100% of the collection. There is a margin. Now that the cost that the Singapore bank has to incur is being charged as a small discount. They will charge you as a discount to the dollar. That is why you don't get the full $1 when you remit. Now, this 99 cents is only something that I just arbitrarily fixed. It is not fixed at 99 cents, might be a little high, maybe 99.9 or something. And it also depends on the currencies, right? So more liquid currencies like the dollar or the euro might have a smaller margin, whereas the less liquid currencies, maybe like the Hong Kong dollar or the Dubai dirham, might have a bigger margin, right? So for those currencies, it might be slightly higher, maybe 95, 0.95, something like that. So either way, you have to factor in the interest cost as well as the margin that is maintained by the bank that you are repatriating to. Yeah, understood?
Excuse me, sir.
Yeah.
Sir, can't we send dollars direct to USA?
We can.
Despite send dollars to Singapore and lower the cost?
Yeah, good question. Can we send dollars to the USA? We can. If we send dollars to the USA and we have Nostra accounts in the US now. So if we let's have our Nostra account, let's say it's Standard Chartered. So we take our dollars to the US and deposit in our dollar account. You're right, we get $1. Whereas if we send to Singapore, we get a 1 cent hit. Now, the only problem is if we send it to the US, the freight cost and all might be higher, right? Because of freight charges. Maybe the insurance cost might be higher. And also, the only currency that we repatriate is not the US dollar. We send all sorts of currencies, isn't it? And so we might send sterling, euros, Chinese yuan, Japanese yen, and Singapore dollars. All these currencies are being repatriated, not only dollars. Yeah. So if we send to the US, yes, we'll get $1 for every dollar that we deposit. But also, what about the other currencies? Maybe the US might charge a higher premium for other currencies, right? Whereas Singapore might charge less. So it's a basket of currency that we send and not just only US dollars. That's a valid question. Good question. You got the answer?
Yes, sir. Thank you.
Yeah. Anything else? Right. So if there are no further questions, shall we have a break and come back? It is now 3:30. Let's come back at 3:50. Yeah. 20-minute break. Okay. Hi guys. Welcome back. Great. For a moment, let's assume that you are trading mangoes, buying and selling mangoes, right? So let's say today in the morning you started with 0 mangoes, no mangoes at the beginning. Right? And then you buy 100 mangoes, let's say at a price of $50. Okay. So let's record the number of mangoes you have and the amount of rupees. Right. So when you buy 100 mangoes, you go short on rupees. because you give your rupees and buy now. Which means here you are short 5,000. Correct? Then let's say you bought another 50 mangoes at a price of 60 bucks. That comes to minus 3,000. Now during the entire day, if nothing else happened, then you will be left with 150 mangoes, which you have purchased at total cost of 8,000 bucks. So your average cost comes to 8,000 divided by 150. $53.33. Right. So the next day you begin. This is day 1, and day 2. You begin with 150 mangoes. You are short of 8,000 bucks. Right. Let's say the next day you sold 30 mangoes that you're selling. So your mangoes will reduce at 8. You're selling 30 mangoes at 8, which means you receive 2,400. And if nothing else happens, you will close the day at 120 mangoes. But rupees will be 5,600. The average cost is then $46.67. Right. Now let's say the next day nothing happened. Day 3, nothing happened. Right? And the price of a mango in the market closed at, let's say, 100 rupees. If it closes at 100 rupees, your unrealized profit, how do you calculate? Closing price of a mango is 100 rupees the next day. We calculate as if you sell 120 mangoes, you can sell it at 120 mangoes. You can sell at a price of 100 bucks. So you will receive 12,000, and your cost is 5,600. So it is negative. You make a profit of 6,400. Okay. So the next day, if either the closing price of the mango is 100 rupees, or if you sell all of your mangoes at 100 rupees, you will be left with a profit of 6,400 rupees. That is how we calculate. Understood? Clear? If this happens, finally you will be left with 0 mangoes, nothing at all. Everything sold out. Now on day 1, right? Day 1, you have purchased mangoes But what if all of a sudden the price of a mango drops to 20 rupees? What if the price of a mango on day one, after your purchase, drops to 20 rupees? You will make a profit or a loss?
Profit.
You have purchased mangoes at 50 rupees and 60 rupees, right? But after you purchase, the price of a mango in the market drops to 20 rupees. You make a profit or loss?
Loss, sir.
Yeah, you make a loss, right? Because you have spent 8,000 bucks to purchase. Now the price of a mango is 20. You will only realize 3,000, so you make a 5,000 rupee loss, isn't it? Which means if you buy mangoes, or if you buy anything, to buy even a car or a house or property or currencies, if you buy dollars, the risk is the price coming down. If the price drops, you will lose. Understood? But if the price goes up, see, if the price goes up, you bought at 50 and 60 and the price goes up to 80, you will make a profit. That's why your average cost comes down. Okay, you're making, you end up with a profit if the price goes up. Okay? So remember, if you buy anything, can be mangoes, can be currencies, can be anything. You buy something, the risk is the price going down. Okay. Now, after all of these transactions, from day 3, you are left with 0 mangoes. Right? If you are left with 0 mangoes, what happens if the price of a mango goes to 500 rupees? The price of a mango goes to 500 rupees on day 4. What will happen to your profit? If the price of a mango on day 4 goes to 500 rupees, what will happen to your profit? Will it increase or will it reduce? Yeah. What do you all think? On day 4, if the price of a mango is 500 rupees, what will happen to your profit? You are left with 0 mangoes. So what happens to your profit?
Nothing happened.
Exactly, nothing happens. Right? But if the price mangoes become worthless, drops to 0, then what happens? If the price of a mango on day 4 becomes 0, what happens to your profit? Yeah,
Nothing happens, sir.
nothing happens. Yes, exactly. So if you have no exposure, to mangoes. Your profit, nothing happens. No exposure means nothing happens at all. Understood? So if you are carrying an exposure, which is called a position, you are exposed to price fluctuations. If the price goes up, you make profits. If the price drops, you will lose. Your position is zero. If you're squared, you have no impact. Profit will not change. Right? So in this case, you are plus on mangoes. So it's called an overbought. Overbought position or a long position. Right? If you are long, remember your risk is the price going down. Price falling is the risk. Clear? Any questions? Shall we try this example? Well, the trading position is where a trader's net position against a base currency can be a net buyer or a net seller. In this case, he's a net buyer of mangoes. As a trader goes through the day, he buys and sells mangoes at varying rates, leading to a net position. Right. A long position is where a trader is a net buyer, right? And a short position is where the trader is a net seller. So remember, if you are long or overbought, your risk is the price dropping. Now, what do you mean by a short position or oversold? We'll come back to that later. Remember, there are two kinds of positions. One is overbought, other one is oversold. Oversold means instead of being plus, if you're minus, it's oversold, right? You have sold excess. Realized profit or loss of a totally squared position where there is no open position. Like on day 3, your mangoes become 0, so you have realized your profits. Unrealized, on day 3, you have sold only mangoes, no exposure to mangoes, you're squared. This is your realized profit. Unrealized is profit or loss of an open position compared with its average rate against the market rate. So unrealized means something like this place, yeah, where you have you're carrying a certain position without selling it off. Then your profit is unrealized. Profit or loss is derived from the counter currency, right? You are quoting the base currency and profit you get is counter currency. It's like this. These are the price of mangoes. The profit you end up is rupees. So let's try this example. 8 o'clock, the sterling dollar is 158.50. 5 minutes after that, the sterling dollar is 158.70. So if you were to make a profit, what will be your strategy? How would you have made a profit in this case? 1 sterling, 158.50 US dollars. Now, if you had purchased 1 million sterling at 158.50, you would have been short of 1.585 million dollars, isn't it? Short of 1.585 million dollars. Right. So now, are you carrying a position or not? Are you carrying a position in this case or not? You're carrying a position. What is your risk? The sterling going up is a risk or going down is a risk?
Sterling going down.
Going down is a risk, right? And this position is called overbought. Right? Let's write it down. Your position and risk. If you are long, or in other words, overbought, your risk is the market falling. Right. Risk is the market falling. Then if you're short or oversold, the risk is the market going up. And the third kind of position is called square position. There is no, you're not carrying a risk. This is how the risk goes. Okay, going back to the example, now we are overbought. So the risk is the market coming down, right? But 5 minutes after this, the market has gone to 158.70. If you square your position, which means now you have bought, square you need to sell 1 million sterling at 158.70. This is 8 o'clock. Then 8:05 you sell it. And you will receive $1.587 million. Now your sterling position is what? Sterling position is
Zero.
Yeah. In other words, position 0 is called what? Square. Position is 0. Sterling position is 0. Your dollar position is 0.002 million. Right? Which means if you square off 5 minutes later, you'll make a $2,000 profit. If you had gone long, okay, you had gone long. Now let's see what will happen if you had gone short. Short sterling. This is long GBP. Now let's see what happens when you go short sterling. What do you mean by short? What do you mean by short? What do you mean by short? Can you tell me what is meant by short?
You're short of sterling.
Okay. Now, if you buy 1 million sterling, that means you are long sterling. So, what is short? Yeah, what you said is correct. What you said is correct. You're short of sterling, right? Now, instead of buying sterling, if you had sold sterling, right? Now in this case, you have bought sterling and then 5 minutes later you're selling now. Now, my question is this short? You have sold here 1 million sterling. Is that short? You have purchased and then you have sold. So, is this short? It is not short. Why? Because you are selling what you have purchased. Right? You are selling what you have purchased. Okay. Short means if you are selling what you don't have. Now, for example, if I bought this pen and if I sell it, then I'm not short. But if I never had this pen, but I have promised to sell it to someone, now I am short. That is short selling. You can sell an asset if you don't have it. If you feel the asset's value will go up or go down, you will short sell if you feel the asset's value will increase or if you feel the asset's value will drop.
Drop, sir.
Yeah. Let me ask you another question. Why will you buy this pen? Or why will you buy anything? Anything, right? Anything. If you buy a car, land, maybe shirt. Why? If you feel the price is going up or going down. Because you feel the price is going up or the price is going down. Yeah, you will buy anything because you feel the price is going up. You will never buy if you feel the price is going down. But if you feel the price will fall, then you will short sell. You will short sell. The short selling means selling an asset which you do not own. Okay. So if you are short selling sterling, you will be short of 1 million sterling at 158.50. Short 1 million sterling means dollars you are long, $1.585 million you are long. This is at 8 o'clock. Then 8:05, you buy back 1 million sterling at 158.70. So if you buy back sterling, you are short of dollars. You will be short of 158.70 million dollars. Sterling position is 0. Dollar position minus $2,000. $2,000 minus. Clear? Any questions? No questions. Okay, so let's try this.
Sir, that in case,
Pardon?
in that case, the he is sort of USD, no, so he's losing that much. He's losing, making a loss.
Which one? Yeah. Yeah. Yes, you're right. You're right. Yes. Sorry. This is minus. Right. See, when you go short, when you go short, and the price goes up, you will lose. That is why short oversold, the risk is the market increasing. But if the market drops, you will gain. Okay. So, for example, if this had been 158.10, you only need $1.581 million, and you will make the profit of 4,000. Is that clear? Yeah, that was a good spot. So the next one, let's try this example. Buy sterling 1 million, 155.10. Buying 1 million. Sorry, it's 5 million. 5 million. to end up with 20 million plus dollars. And sorry, 20 million sterling, 31.085 million dollars. Right. And your average cost. Okay. Clear? Any questions? Let's try the next example. By 5,093,40 by 10 million and 93.25 by 5 million 93.55 and you sell 10 million 10 million at 93.10. So long buying Aussie means you're selling dollars. Short 4.67. Short 9.325 million. And when you sell Aussie dollars, you will receive US dollars. So here, your plus 9.3. Yeah. So your average cost $9.3625 divided by 10 million comes to 0.963. Okay, so the next question is, if the market closes at 93.89, will you make a profit or a loss? The market closes at 93.89. Are you going to make a profit or a loss?
Profit, sir.
You make a profit or loss? Yeah, yeah. Because your cost is 93.63 and the market is higher than that. Right? So you make a profit. How do you find the profit? You're ending up with a overbought or long position of 10 million Aussie dollars. So to bring it to zero, when you bring it to zero only, you can calculate the profit. You need to put minus 10 million at the closing price of 93.89 comes to minus Aussie means plus US 9.389 billion. So your Aussie dollar position is zero. So it's about $26,500 profit. Okay. Any questions? No questions. Which means either you understood everything or you understood nothing. Yeah.
Excuse me, sir.
Yes. Good.
Sir,
Question. Yeah.
why did you put a minus mark for the calculation above calculation for purchasing for buying AUD? You have put a minus mark for US dollars.
Which one?
Why
Here.
is that, sir?
This.
Yes.
Okay.
Yes.
You should have asked it at the beginning. I was using it right through. See, when you buy Aussie dollars, remember the mango example? Mango. When you buy a mango, you have to give rupees. No? Right? So mangoes come to you, inflow of mangoes, outflow of rupees. No? Isn't it? Understood?
Yes, sir.
Yeah.
Yes.
Same thing. When you buy Aussie dollars, your US dollars go out. And when you sell Aussie dollars, your US dollars come in. Same principle.
Yes. Yes. Understood. Thank you, sir.
Yeah. Okay. Any more clarifications? No more?
So our profit is in USD, no?
Yeah. Yes. Because your Australian dollars is 0, you will be left with only US dollars. Right? Because if you buy a mango for 100 rupees and if you sell it at 150, you will be left with 50 mangoes or 50 rupees.
Okay, sir.
50 rupees. No? Yeah. So your profit always comes in the counter currency. Right? Okay.
Okay, sir.
Yeah. Any more questions? Cross rates. Right? Now, the examples that we were doing earlier, US dollar LKR is direct quote, LKR US dollar indirect quote. So if the local currency is quoted first, it is a direct quote. If it quoted second, if the local currency is quoted second, it is a direct quote. Local currency quoted first, it is indirect quote. But what happens if the local currency is not there? Like this case, Aussie dollar against US dollar, no local currency. Then it's called a cross rate. This is called a cross rate because it does not have our local currency. It's as simple as that. Now, sometimes some of you all may be asking cross rates for your customers. Right? So you have been asking saying cross rate, but the meaning is it doesn't carry the local currency. A cross rate is where the local currency does not appear. Normal market practice is to construct a cross rate where the stronger currency becomes the base currency in the cross currency quote. Okay? The stronger currency becomes the base currency. Okay? Let's move on. Okay. Now you have been given euro dollar and sterling dollar. Can you calculate euro sterling? Shall we try these examples? Euro dollar 133.56. Sterling dollar 156.75. Just to calculate euro sterling. What is your guess? This rate should be more than 1 or less than 1? Yeah, less than 1. Why will it be less than 1? Because both the euro and sterling are stronger than the dollar, but sterling is stronger. Okay, so if euro is the base and it is weaker, it has to be less than 1. Now, what should we do? You have been given euro dollar and sterling dollar. Asked to calculate euro sterling. So, what have you got to do? You need to get the dollar also in between somewhere. So, you put the dollar in between, euro dollar and dollar sterling. Right? Now, something like this 2 by 3 is equal to 2 by 5 times 5 by 3. Isn't it? Something we did studied in grade 2. These cancels off and you end up with 2 by 3. Same thing, I have inserted the dollar in between. And then now we are on familiar grounds. euro dollar is given 133.56 into dollar sterling is not given, but you have been given sterling dollar. Okay. So let me write an additional step. What if I write this as sterling to US dollar? Again, what I wrote earlier, 2 by 3 is 2 by 5 times 5 by 3 is also equal to 2 by 5 times 1 over 3 by 5. Yeah, so the same thing. Euro dollar 133.56 into 1 over 1.5675. Quite 8521. Yeah. So the next one, dollar yen. $98.90. Dollar rupee. 133.60. What is yen to rupee? Same process. You insert the dollar in between. Dollar yen times yen dollar is not given, but it is the inverse of dollar yen times dollar. Any questions? So euro dollar given 1.356 into dollar rupee 133. Any questions? No questions. Right. Yeah.
In third example, we multiply those now according to that euro AKR, it should be divided.
Come again.
In the third one,
Yeah.
we multiply that one.
Yeah.
But according to that euro divided by USD multiplied by USD LKR, that should be divided as it seems.
Why divided? The euro dollar is given and dollar rupee also given, right? So it has to be multiplied, right? But if this was the other way around, if it was dollar euro and then dollar rupee, then it will be divided. But here, multiply. See, it's a little different to the rest. Because in this, you had to get the inverse. Whereas in the euro rupee, you don't have to. Inverse is not required. Sorry. Okay. Now let me teach you all a shortcut. So this is the fundamental. But if you look at each of these currencies, at euro dollar is an indirect code. Sterling dollar also indirect code. So they're the same kind. And you have divided the two rates. Then dollar yen direct code, dollar rupee direct code, same kind, you divide it. Whereas euro dollar is indirect code, dollar rupee direct code, different kinds you multiply. Okay. Then remember, If they're the same kind, that means indirect, indirect, or direct, direct, you divide. But if they are different kinds, indirect and direct, you can multiply. You need to multiply. Okay, so that's how the treatment differs. Yeah. So the shortcut would have been, without going through this entire process, if you identify that both are indirect and you have to calculate the euro sterling, then you need to figure out which one is whether euro is the stronger or the weaker currency. Euro is the weaker currency. Both are the same kind, so you have to divide. Then you divide the euro rate by the sterling rate, because your exchange rate should be less than 1. To get exchange rate less than 1, you have to divide euro rate by the sterling rate. Then here also both are direct. Both are direct, you need to divide, and you have to calculate yen to rupee. Right? Yen to rupee, yen is the stronger currency, right? So yen to rupee should be more than 1. You need to divide the rupee rate by the yen rate. Whereas here you have indirect and direct, so it's multiplied. Whether you multiply euro by rupee or the rupee by euro, you can get the same answer. Clear? Understood? Any questions on that? All right, so let's calculate these. Slightly more advanced, very slight. Euro dollar 133.5560. Sterling dollar 156.7580. And you have to calculate euro sterling. So both are indirect. Both indirect, meaning you need to divide the exchange rates. Divide. Okay, so you divide. Now, which one is the stronger currency? Sorry, euro is the weaker currency, isn't it? Euro is the weaker currency, meaning the exchange rate you get should be less than 1. So you have to divide the euro rate by the sterling rate to get an answer which is less than 1. Now, when you divide, there are 4 different combinations. Either you can divide the 2 bits, euro bit divided by sterling bit, or you can divide euro bit by the sterling offer. Yeah. Then you can divide euro offer by sterling bit, or the euro offer can be divided by the sterling offer. 4 different combinations. Which one do you use? See, you have got the bid and offer, and you asked to calculate the euro sterling bid and offer. Euro sterling bid and offer. Now, what you should remember is the bid should be as low as possible, offer should be as high as possible. And so you have to take the furthest. For you to arrive at the furthest quotes, you have to divide across. Like you have to divide in this direction. So it will have to be the euro bid divided by sterling offer, and the euro offer divided by the sterling bid. .85. And so if you write it in pips, it's 85, 17, 23. Okay. So both are direct quotes, and you have to divide. Also, the Canadian is stronger than the rupee, so it has to be an exchange. The exchange rate you get has to be more than 1. To get a rate which is more than 1, you have to divide the rupee rate by the Canadian dollar rate. Okay. Again, both are direct. Both are direct means you have to divide, and when you divide, you have to divide the rupee offer divided by. Sorry, you have to go across. You need to go across. Did all of you get these answers?
So, that one 133 30, no?
25, 30. Ah, yes, you're right. In terms of pips, 134, 73.85. The next one is euro dollar 133.55.60. And dollar rupee 133.25.30. Now you have an indirect and a direct currency. Right? So you need to multiply. When you multiply to get the lowest bit, you have to multiply the two bits. You don't go across, you go straight. Multiply the two bits, and to get the highest offer, you multiply the two offers. Euro rupee comes to 33.55. Can also write it as 177.96.09. Right? Although two different big figures, if you write 96.09, it means 177.96 and 178.09. Okay, is that clear? Do you all have any questions? Right, so no questions. We will move on to the next one. It says a German importer would like to buy sterling in terms of euro. At what rate can he buy from the bank if the following market rates prevail? Euro is the base currency. So you'll be given euro dollar and sterling dollar. Okay, so this guy is a German importer, meaning his currency is euro, and he wants to buy sterling. Okay, so let's try this. German importer needs to buy sterling. You have been given euro dollar 132.2025, sterling dollar 158.75.8. So let's find euro sterling. Both currencies indirect, meaning you need to divide, and when you divide, you go across. So it's 132.20 divided by 158.80. Upper will be 132.25 divided by 158.75. So it's a German base. He wants to buy sterling. So he'll have to sell euro, buy sterling. Sell euro at 83.25. That's going to be the rate. Clear? Any questions on that? He needs to buy sterling. To buy sterling, he has to sell euro. He'll be selling euro at 83.25.
So he has to buy that at the selling rate, no?
No. He has sterling now. Sorry, he has the euro now. And he needs to buy sterling, right? Isn't it? So the base currency is euro. And he needs to sell the base currency, correct? So he will be selling the base currency at the bid. Isn't it?
From his side, we are looking at, no?
Yeah. He's the market maker or the market taker?
He's the taker.
He's the taker, right? So he'll be selling the base currency at the bid. Okay. Any more questions? No? The next question. Sri Lankan tea export. Right. Let's go through that. The Sri Lankan tea exporter would like to sell his euro receivables. At what rate can he sell if the following market rates prevail? Given euro dollar 132, 20, 25, and dollar rupee 132, 50, 60. Right. So we have indirect, direct. Two different kinds. What do you do? Divide or multiply? You need to divide or multiply?
Multiply.
Multiply. When you multiply straight. So 50 would be 132.20 into 132.50 and 132.25 into 132.60. $175.16. $175.37. So it's a Sri Lankan tea exporter. He will receive euros and he needs to sell his euro. Right. So euro is the base currency. He will be selling the base currency at the bid. So this is the answer. 175.16. That is the rate that he will get. Okay. So any questions on this? No questions. Yeah. Well, if that's the case, time is up. So let's wind up for today. And I will see you all next week. If you have any questions, you can always ask. Go through what we did today. Stay safe and have a good week. I'll catch you all next week. Same time, 1:30. Thank you, guys.